Hey guys,
Hey,
Morning.
good morning.
how you guys doing?
Pretty good, I think, all things considered. It's getting into that Halloween season.
It is. Well, hey, I had an idea. I'm going to skip any kind of culinary or witty banter this morning, and I'm going to jump right in because we have a lot to cover, and we've been having to cut question time short the past few weeks. Everyone good with that?
Yep, let's go.
I'll miss it, but go ahead.
All right. So, hey, welcome everyone. Welcome to our DAT IQ weekly market update. We're here every week. Myself, Ken Adamo, Chief of Analytics at DAT, Ned Damon, Principal Data Scientist, and Dean Croke, our Principal Industry Analyst, talking about the freight markets, what's happening, what's happened over the past week, and most importantly, what's happening in the future. We're going to skinny things down a little bit this week to make sure we save enough time for discussion and questions at the end. But I want to make everyone aware that the full depth and breadth of content is available at dat.com/market update. Dean provides that every week. And if you can't make it to watch us live, but you do have a question or something sparks in your brain after you finish watching today, askiq@dat.com is a great way to get in touch with us. And I have one more point. Next week, we'll be joined by Dr. Chris Kaplis, who's the chief scientist at DAT and heads up the Center for Transportation and Logistics at the hallowed halls of learning of MIT. So I'm really excited. He brings a great shipper perspective, and he will be here to help us understand what shippers are thinking about over the next year. So without further ado, I'm going to turn it over to Dean to get us started.
Okay, diving straight into this week's market update on the load post, load board activity side. Load post dropped about 3% week over week, but it wasn't uniform. On the capacity side, refrigerated and flatbed truck posts were up, which is generally a sign that capacity is increasing. But in contrast, dry van truck posts were down 3%, which we think is a reflection of the busy e-commerce week that kept a lot of dry vans busy last week. The load to truck ratios generally across all three equipment types are up 66% year over year. So they're up a lot on 2019, but down 3% week over week. A little bit of cooling in the market. The dry van LTR at 4.23, refrigerated load to truck ratio at 8.41, and flatbed at 37.15. Moving over to the market condition index, a couple of markets we want to highlight this week. Load posts in the dry van sector dropped in our top 10 markets. They represent about 22% of our total volume. They were down about 5%, but the big market of Memphis, it's generally our number one market. That's on our radar this week. It's well known as the logistics hub of America. It's the second busiest air cargo hub. We've got 5 Class 1 railroads that intersect there. It's at the middle of a couple of large interstates, I-40 and 55. So what that means for truckload, you've got a lot of outbound volume for all equipment types. But last week, volumes were down 14% week over week. So a little bit of a drop in volume after a big push of inbound freight, mostly related to e-commerce. Capacity is still tight, though, for carriers and brokers. Rates are up 2 cents per mile to $2.59. On the West Coast, one market we all need to watch in the coming weeks, Los Angeles, Ontario volumes are down 4% week over week. They've been trailing off for the last 3 or 4 weeks, but capacity is still tight. Rates are up 2 cents a mile to $3.04, so they're still quite high. Capacity is tight. But what we need to watch is that import volumes are again beginning to accelerate. And in the Journal of Commerce today, they had a great piece about how volumes are expected to worsen and over the next 2 weeks, owing to what they call record level of imports. So when they say worsen, they mean that a lot of the congestion that normally plagues that port will start to reappear as we start to bring in more PPE, e-commerce fulfillment, inventory replenishment that's going on. There's a lot of holiday season inventory. There's even signs that spring 2021 inventory is starting to be pulled forward. So we can expect a lot more volume on the West Coast in coming weeks. On the refrigerated side, we're just 4 weeks away from Thanksgiving. We're starting to see a lot of refrigerated volume in major produce markets. The market we're watching this week is North Carolina. It's the number one state for turkey production. Reefer volumes outbound spiked 24% last week. Spot rates are up 6 cents per mile to $2.36. Competing for capacity is also the sweet potato harvest, which is at peak. North Carolina is also the number one state for sweet potatoes, and they'll push out about 70,000 truckloads during the season. A lot of activity in the North Carolina region. And over to our year-over-year dry van spot rate view. Dry van spot rates stayed relatively flat last week, a little bit of an indication that they're plateauing and some resistance to moving much higher than the $2.25 per mile mark. It's still the highest rate in 5 years. years, and rates are up 51% year over year. This time last year, rates on the dry van side were $1.49 a mile, excluding the fuel surcharge. So they're up 76 cents a mile in 12 months. Over to refrigerated, spot rates are definitely plateauing around the $2.38 per mile mark. They've been working in a narrow 4 cent per mile band for the last 4 weeks, so there's clear resistance to moving much higher at the moment. Those rates are up 60 cents a mile compared to the same week in 2019 when they were $1.78. And lastly, on flatbed, rates ended where they started at $2.24 a mile. Normally what happens this time of the year is temperatures drop, so do spot rates. The bright spot that's been keeping flatbed carriers busy is the housing market. Today's release of the census data shows that building permits are up 5.2%, and single-family housing starts, which represent about half of all new homes, housing starts are up 8.5% month over month, driven by low interest rates, urban flight to low density housing better suited to working from home and schooling. About 56% of the new home starts will be in the south. So it's important to watch for flatbed carriers sort of south of I-40 and east of the Mississippi River. You can find much more detail about this week's freight market update at dat.com/resources. And Ned, that's it for this week's market update. Over to you to talk more about the rate forecast.
Before we do the rate forecast, I believe that we have a bet to settle, and that is
well, we don't settle until next week, right?
Fair. But we do get more information about it. So this is Rate Watch 2020. So you can see that we all have put down our markers. Me at $2.30 a mile, Ken at $2.20 a mile, and Dean at $2.10 a mile. And we're operating under Price is Right rules. So that is the closest without going over to the rate wins. So right now, the current value of the van rate that we are going off of is, I believe, $2.26 a mile. Mm-hmm. So as an additional note, Ratecast is forecasting that it's going to come in just under my marker at about $2.29. So you live by the forecast, and sometimes you shoot just a hair high. We'll see what happens. Ratecast is pretty accurate at this range, and so I have a feeling that Ken is heavily favored at this point. But,
I don't know, Ned. I'm getting a little nervous. There was an article that came out, was it earlier this week or late last week, Dean, about UPS, FedEx, and Amazon all being essentially oversubscribed at this point for truckloads through the end of the year.
Yeah, this week.
That could provide that little oomph to get over that resistance.
It's going to be close. But
it's only 7 days, though.
That is the main thing, is that again, Ratecast accuracy at this range is pretty good. So if we were going to have the old I don't know, like value percentage chance to win, I think I'd put you at about 70, me at like 20, and Dean at like sub 10.
Less than 1%. Well, hey, we always say don't guess no, right? So yes. I think that's kind of the tagline here, is to see what Ratecast and see how the actuals come in, because this is, I mean, I do still think we have another week left of that seasonal softness before kind of rolling into Black Friday. But why don't you, if you don't mind, Ned, going through the Ratecast spaghetti charts?
Oh, no, not at all. I love talking about spaghetti. So this week, we're just going to be looking at the dry van forecast, again, as part of our operation to provide a kind of leaner, meaner amount of content here. So here we're showing the Ratecast forecast plots for dry van. In blue, you can see the historical rates. And then in red, you will see the short-term forecast. In green, you will see the Ratecast forecast. And in gold and gray, you will see the two blended forecasts, which are mixtures of these two forecasts in different ways and in different amounts. And one of the things that really strikes me here is, unfortunately for me and my success at this bet, there's a lot of model agreement, and that model agreement is pointing towards continued flatness going in through the first week of November. So I haven't completely given up hope, but it's definitely looking like all the models are agreeing or more or less agreeing, and it's in the flat direction. So forward without going up or down too much. Again, there's a little bit of disagreement about the exact pattern. Ratecast sees a little bit of a dip before coming up. Short term is seeing a little bit of growth before plateauing, but we'll see what happens. And I think that is it for the forecast plots. Again, if you want the other forecast plots, you can either go to AskIQ, that is email askiq@dat.com, or the written market update, I believe, also contains those.
For sure. So we talked about last week on the show, we always do the 35-day forecast juxtaposed against the most recent actuals, but there's a lot of demand for a longer term view. A lot of people are mired deep in RFP season right now. So Ned, do you mind teeing up the Ask IQ question for the week?
Not at all. So the Ask IQ question of the week is, it's RFP season, so what does Ratecast see for long-term trends? And so let's pull up some charts. Let's talk to some charts.
All right. So I shared one of these out on LinkedIn yesterday, and it's been a great discussion. So I'm going to hopefully wrap some of that into what we talk about today. So this is an interesting view, and this is one I think more people should build into their workflow. So just to level set, this is not absolute rates. If you look at the y-axis, this is year-over-year change. Right, so if you just looked at this chart and didn't really pay attention to the axis, you might think we're predicting this huge rate collapse. But in reality, what happens is a lot of our businesses are predicated on year-over-year comparisons. So we want to grow, which means we want to have positive year-over-year growth. But when you see these huge spikes or these huge dips up or down, those become very important when we look at year-over-year comps the next year, right? So if rates are really, really high right now, it makes it much more difficult next year to build on top of these extremely abnormal elevated rates, right? So even if rates are good next year, if they're not as good as this year, your year-over-year comps are going to be low. So what this is saying is, obviously we're in a time, if you look at where the blue line ends, that's the end of our actuals. And the reason we showed this little bit of a dip, right, is just that after, Christmas, it's just typically a slower time of year. And then we see strength pulling into the 4th of July timeframe, and then rates beginning to struggle to meet those year-over-year comps. So when we flip to the next chart, it brings in those actual rate per miles. Now, I just want to call to attention one thing. The rates we use here are going to be a little different than what we're using for the rate watch or the forecast. Those use a larger basket of shipments, so anything I think over 250 miles.
Yep.
But we identify that there's some price friction in that 250 to 550 bucket. And for this view, we want to show just long haul shipments to make sure we're capturing pure rate movement driven by market dynamics, right? So I would focus less on the absolute dollar number and more on the trend. And then just to make it easy, I put on the gray on the back is basically the same chart we just viewed. It's just in gray. It's the year-over-year change. So what you can see is very evident to freight cycles, right? It picks up at the end of the polar vortex freight cycle, the down market during the industrial recession, the up market during the ELDs, the slow year of the end of 18, all of 19, and now COVID. So in absolute terms, what we're predicting is, rates to stay relatively strong through the holiday season, come down a bit once returns are over in January, and then recover heading into spring of next year and remain relatively high through the summer. But I said a lot of words there. What do you guys want to add from a context perspective or challenge that thinking?
So one of the things that I really want to call out is that the Ratecast model is a model, and so it's based on normal fluctuations of current trends. So if, for example, there's another lockdown, if there's a second wave of COVID infections that's going to cause a lot of changes in industrial production and in how just sort of freight volumes are moving, then I think that we're moving back into uncharted territory, and these long-term forecasts would be, I'd lean on them a little bit less, and I'd lean more on a short-term forecast and having a more short-term perspective when things are that unsettled.
Yeah. What are you thinking?
I'm just taken by the dip in 2019 and one of the questions we just had about new truck orders, and I can't help but think we're some carriers might be thinking the same things they were thinking when spot rates were high in 2018, and we had this record number of trucks and trailers come into the market. We're seeing really high levels of trailer orders coming into the market, which is, an expectation of where capacity is being viewed this time next year, maybe a little bit earlier. My concern is that demand won't be there, and that we'll have this overcapacity situation again, and we'll make the same mistakes we made in 2018 into 2019. There's just so much uncertainty, but what we do know is that trailer utilizations are way up at the moment. They're up about 21% year over year. So trailers are very busy. Trailer orders look strong, but I just don't know that that's sustainable into the new year. I feel like we'll follow this same cyclical pattern of up one year, down the next, and then up and then down.
Yeah, I don't know if we can go back to the chart. If not, I could just talk to it. But I just want to be real clear. In my perspective, so we're kind of moving away from data into opinion, and I think that's a great way to approach this, is to use a technical forecast, however you develop it, whether you grab it from DAT or do a blend of DAT in your own, or however you approach it, and then really look at like what you know to be true, what you would call like a fundamentals, like what are the market fundamentals to help guide and shape different things. So what strikes me here is, and I'm really glad I did this chart because it's something I would have never seen had it not been laid out this way. If you look at the entire last two freight cycles, from the start of 14 to basically the start of COVID, there wasn't a ton, if any, actual spot market inflation. If you look at like where those two inflection points crossed, it's really right about $1.50-ish. Now the peaks have gotten higher and the valleys have gotten lower, but where they ultimately come to rest, if you will, hasn't changed much, which indicates to me that there's a ton of downside risk in 21. And what I mean by that is, if we start the next rate cycle, even at flat year-over-year comps, we're still looking at rates at $1.60 to $1.70 a mile, which would be 10, 20, or even, if they're at $1.80, 30 cents of inflation over an 18-month period, which I think that's a paradigm shift that we would all in the industry have to deal with, I think. So that's something where I say, like, I think the fundamental forecast gives us great context, but I would also layer in this sense of what we know to be true about markets and what we've seen experientially.
Another thing that I feel like is important to talk to is understanding how to like find your lines. And what I think to explain that a little bit more, there are outcomes that are on this chart. Like we show like the upper, the middle, and the lower, but there are also like tail risks that are higher and lower, and trying to understand like what the odds of these various tail risks are, I think is really important. And also knowing what your play is when one of these things happens, right? I think for a lot of brokers, missing in one direction isn't so bad. Missing in the other direction can be really brutal. And so knowing what you need to do to compensate in case you miss in the wrong direction. And for carriers, the opposite, right? Like if you expect rates to be higher and they drop, they undershoot what your projections are. Knowing what you need to do to continue to stay in business and to continue to operate, I think is really important, because there are those tail risks, especially when you're in this kind of an unsettled situation.
For sure. I'm going to hit a couple of the questions and comments, if that's cool with everyone. So this is from Stephen, who misses the breakouts. We can try to work more of those in. Again, if you go to dat.com/market update, you can get all of that content available there. We can take that away as a note for next week to maybe bring in some more of the load and truck data.
He also wanted the reefer forecast too. I think it's the same Stephen. So
that might be Stefan.
Oh, that might be Stefan. Okay.
F versus so Stefan.
No, those are two different humans. All right.
Okay.
Yeah, no. Different people, both. Yeah.
Yeah, let's put a pin in that. Well, maybe we'll bring the reefer forecast in, the long-term reefer forecast next week. Sound like a plan?
Sounds good to me.
So TNS, what are you using to optimize the forecast model? So without spilling the secret sauce, Ned.
So one of the things I'd say is that because Ratecast is forecasting so many lanes, we can't do a lot of like individualized per lane or per equipment type hyperparameter tuning. So for us, kind of our biggest optimization strategy is just having a lot of data. And I think that that's one of DAT's strengths, and one of the reasons why we're able to generate the fidelity of the forecast that we can is we've got a lot of data. As far as optimizing some other things, I can talk a little bit more to the short-term model, I think. And one of the big keys about the short-term model is a lot of short-term models are going to tend to run off towards, not really positive infinity and negative infinity, but they're going to tend to overreact to things. And so one of the real keys there is keeping ceilings and floors, like saturating ceilings and floors on your models to make sure, especially when you're like extending a shorter term forecast out, that it's not going somewhere ridiculous, because a lot of linear models will tend to just go off into the wild blue yonder, because again, models are based on things continuing with adjustments that you expect, and in the real world that doesn't happen.
Right. So Gary had less of a question, more of a comment. 17,000 new homes in Florida alone last year. Dean, we saw that post from Jason Miller at Michigan State about lumber inflation. It's just remarkable, right?
Mm-hmm. Yeah. It's unprecedented. I think the volumes are up year over year by about the same magnitude. They were up month over month. So building expectation, the Wells Fargo Builder Sentiment Index is up at record levels. It hit 85 index points yesterday. So lots of optimism in the building market, and single-family housing starts are the most important to watch, because they're the most freight intensive from a flatbed carrier perspective, and that then precedes the volume of freight that dry vans haul for furnishings. So lots of activity in the South in particular.
Yeah, so I'm going to move on to Stefan's question, first question, about Class 8 truck orders. And I think Dean and Ned, you talked on a bit of it. I just had a little color to add. We've had really good conversations. So the question, just to repeat it, was about Class 8 truck orders, and do we think carriers will be hesitant to pull the trigger on investing in power units? So we've seen the trailer investment spike, right, but not necessarily Class 8 truck orders. And I think what I've heard directly from carriers is, yes, they're afraid the volume's going to fall out, but what's going to put their mind at ease will be contract rates taking that step up and staying high for, I don't think it's a hard and fast rule, but at least a few months to maybe a quarter and a half of increased contract volume, because that should protect them should the spot market kind of bottom out a bit. Does that jive with what you're hearing, Dean? You talk to a lot more carriers than I do.
Yeah, certainly very cautious. I think there's a couple of things that are working against the larger carriers. That's the supply of drivers. It's a very valid challenge they've had in getting drivers through driving schools and through the certification and licensing process. So definitely there has been some issues getting drivers into trucks, but I think also there's been some cautiousness in terms of adding more capacity and making the same mistakes they made in 2018. And what makes me think that they'll be more cautious and capacity will remain tight is the auction volume that we saw in June from JD Power. Auction volumes tripled in June from about 300 Class 8 trucks in the 4 to 7 year old range. They tripled in June. So, why do suddenly 3 times the number of trucks hit the auction blocks? Could have been the outcome of that disastrous first and second quarter that we saw, where rates plummeted and a number of carriers exited or just sold trucks on the auction market. Interestingly, in July, auction volumes came right back down, but in a month after, new owner-operator certifications through the DAT process started to spike. So you could see an exodus of carriers from the industry when rates were low, and then as soon as spot rates started to spike again, another wave of new entrants came into the industry. So I think there's a part of the industry in terms of the capacity that kind of comes and goes depending on how good spot rates are. But at the larger fleet level, where there's much more planning goes into it, I think they're going to be much more cautious and hold capacity levels certainly where they are without knowing what demand looks like next year.
We have a question from Jessica. With the rate COVID is keeping brick and mortar under tighter restrictions, e-commerce will be the reason that dry vans thrive until the end of the year. I'm curious in your guys' perspective on that. Right now, both the dry van and the reefer forecasts, as far as I'm seeing, are at least through the middle of November looking a little flattish. That does. And then that comment is echoed by Secret Bean, who said during cold season, dry van will lose some ground to refrigerated carriers due to needed temperature control. So those two seem to be in a little bit of tension. Do you guys have any perspective on that?
I mean, you'll see protect from freeze come into the refrigerated market for dry van freight when temperatures start to get down below 7 degrees. So until you get really cold temperatures up in the Dakotas and across through Minnesota, and you won't see a lot of that come in until after January, I think. But again, capacity is going to move around a lot. There's certainly going to be demand for refrigerated carriers to haul dry van freight, but you're also going to have a lot more capacity in the market because carriers that haul dirt and gravel and snow, depending on the weather season, they'll be under dry vans hauling e-commerce. So there'll be a lot more capacity in the market just because it's winter and it's colder. It's also the time of the year when a lot of local drivers get furloughed, depending on how much snow and salt there is to haul. So there's a lot of capacity available for both dry van and refrigerated because other markets are in their downside. The other thing that's kind of fascinating to me is that we touched on a little while ago, trailer utilization level from trailer telematics company Spirion shows that the number of miles trailers are doing are up 21% year over year. But what's important, the number of hours that they sit idle is down 30% year over year. So dry van trailers are in great demand at the moment, particularly for e-commerce. I think a lot of trailers are being used as that mobile storage in drop and hook situations where shippers are having trouble getting that freight through their docking process.
Yeah, I think it's pretty much consensus, right, that we should be busy. Frankly, even if rates drop 20 cents and volumes remain high, that's still a terrific fourth quarter for pretty much everyone involved in the space, I would guess.
Except for I think there'll be winners and losers again, Ken, just like there has been in the retail. Non-essential retailers' volumes are down, right, but others are up. And I think manufacturing numbers aren't improving where people would need them. So I think there'll be some flatbed carriers doing really well with building materials, others hauling machinery, not so much. So it's with volume down slightly to flat year over year, it just means that there's a lot more activity in one particular sector of the market, and that's what's going to keep carriers busy. Hopefully there's enough volume there to keep all of the carriers busy that are not hauling the freight volumes that are flying off the docks.
I think the dispersion is really interesting to talk to because I know that we were talking about the challenges of modeling things because sometimes it seems like things ought to be a particular way or there's some kind of like a baseline that people want to talk to, but there's just so much dispersion in the market that's not necessarily the case.
That's a great segue, Ned, because I'm going to wrap real quick after I ask you this question. So we had a great discussion on LinkedIn on Friday. We've been getting a lot of feedback and reports from folks who were seeing some just really wonky rates out there in the market, especially coming off the West Coast. And part of that discussion, a lot of customers reached out, or a lot of folks reached out and said, when they asked the question, the answer they're given is, well, those aren't the rates like as they are, they're what the rate should be based on cost plus and these other modeling techniques. So setting aside the obvious, can you just walk through why we take the approach of like what rates are versus kind of modeling what rates should be in absence of any actual data?
I mean, modeling what rates should be in the absence, in kind of like a frictionless spherical cow sense, is really valuable because it gives you like a baseline to shoot from. The problem is that we're not in like a frictionless, airless spherical cow situation. We live in like a modern capitalist society, and part of that is that things are worth what people are willing to pay. And so those kind of modeling exercises are really interesting for giving you like the ability to gut check and the ability to see like, are things overvalued relative to expectation? And this is also something that to go back to that cost plus, I think that it's really challenging for people to move in a space where things don't have like a real value, right? Like, if you're a carrier, you know what your operating costs are, and the cost plus model is really attractive, but the risk there is that you're losing a lot of the upside variance that you can get when you have the ability to like grab those dollars. And
or volume you lose out on when the market goes down and you're not winning any shipments. And again, I think cost plus kind of makes a lot more sense in the long-term contract market when you're looking at capital investment and kind of the long arc of like inflationary or deflationary pressures on rates. But I mean, I guess to put the finer point on it, if you see any, and this is to all of our viewers out there, just kind of as a word of caution, if you see rates in the $1.50 range coming off the West Coast right now, I would highly recommend fact checking them against a more reputable source, because that is not what we are seeing, and that's not what. What's that?
That's not what people are paying, right? Like,
right.
You do not live in magical like cost plus land. You live in the fact that like national van rates are $2.26 a mile. Like, you know, I was blown away by that not that long ago, but that's the world.
I think it's important, right? And I'll wrap with this, just because another piece of advice would be to, I mean, I did the same thing, right? I wondered, the first thing I jumped to is, could we be that far off? And so I reached out to my network and kind of put my ear to the ground and started validating. So I would recommend that at all points, right? It's someone on the comments brought up a great point about Wall Street analysts will even reach out and do checks with their, folks in the know before they kind of go big on a big quantitative prediction. So with that, I'm going to wrap up. I want to thank everyone for joining us. Again, we're here every week talking about the freight markets and what's going on. We will have Dr. Chris Kaplis here next week. So if you have any questions ahead of time, feel free to think of them and bring them with you, or send them in ahead of time, specifically pertaining to shippers and procurement. AskIQ at DAT.com, DAT.com/market update for all the charts and graphs. And with that, we're going to sign off and talk to you guys next week. Bye.
Bye.
Bye-bye.